Module 7, Blue Chip Investing Strategies 2, Market timing refers to the practice of trying to predict the future direction of the stock market or specific stocks in order to make investment decisions. It involves attempting to buy stocks or other investments at the lowest possible prices and sell them at the highest possible prices. While it may seem tempting to time the market and make short-term gains, it is widely recognized as a challenging and unreliable strategy. Here are a few key points to consider. Difficulty in timing the market. Timing the market consistently and accurately is extremely difficult, even for experienced investors. The stock market is influenced by a wide range of factors, including economic conditions, geopolitical events, investor sentiment, and corporate performance. Attempting to predict these factors and their impact on stock prices is a daunting task. Short-term volatility. Stock markets are inherently volatile, with prices fluctuating on a daily basis. Short-term price movements are often driven by market sentiment, speculation, and short-lived events. Trying to time the market based on short-term trends can lead to increased trading costs, missed opportunities, and potentially poor investment decisions. Long-term perspective. Investing in blue-chip stocks with a long-term perspective has historically been a more successful approach. Over longer time periods, the stock market has demonstrated a tendency to rise, reflecting the overall growth of the economy and companies. By staying invested for the long term, investors can benefit from the power of compounding returns and potentially capture the market's long-term upward trajectory. Time in the market versus timing the market. The concept of time in the market emphasizes the importance of being invested in the market consistently over time, rather than attempting to time short-term market movements. Missing out on just a few of the best-performing days in the market can significantly impact overall returns. Trying to time the market effectively requires both accurately predicting when to exit and when to re-enter, which is extremely challenging to achieve consistently. Risk of missed opportunities. Market timing carries the risk of missing out on significant market gains. It is often observed that the best-performing market days tend to follow closely after the worst-performing days. If an investor tries to time the market by exiting during a downturn, they may miss out on the subsequent recovery and potential upside. Discipline and emotional bias. Market timing can be influenced by emotions, such as fear and greed. Emotional decision-making can lead to impulsive actions based on short-term market fluctuations, which may not align with long-term investment objectives. Maintaining discipline and a long-term perspective is crucial to avoid making irrational investment decisions. Instead of trying to time the market, a more prudent approach is to focus on fundamental analysis, asset allocation, and diversification. This involves selecting quality investments, maintaining a balanced portfolio, and staying invested for the long term. By adopting a disciplined investment strategy and avoiding short-term market timing, investors can reduce transaction costs, minimize emotional bias, and increase the likelihood of achieving their long-term financial goals.